Welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. In this video, we'll be talking about Kenya's National Infrastructure Fund, which we describe as a ambitious vision, and also some are calling it a risky gamble. Kenya's new big bet, which is the National Infrastructure Fund. On paper, it promises to solve the country's chronic infrastructure shortfalls without adding more debt or burdening the taxpayer. But as a project manager expert would tell you, its success depends on execution, governance, and political will, and those remain deeply uncertain. Let's first of all unlock what is the NIF and what it's supposed to do. Kenya National Infrastructure Fund, NIF, is a government-backed financing mechanism unveiled in late 2025 as the centerpiece of bold infrastructure push. According to official statement, the fund aims to mobilize up to 5 trillion Kenya shillings over time by pooling resources from privatization proceeds, capital markets, public-private partnership PPPs, and other investment vehicles, all with the stated goal of avoiding new borrowing or tax hikes. President William Ruto and his administration have described the NIF as the financing backbone for a sweeping program of mega projects, from 1,000 kilometers of new roads, dams, irrigated farmland, to power expansion, water infrastructure, and logistics corridor linking rural and urban Kenya. To seed the fund, the government has offloaded a portion of its stake in one of Kenya's largest corporations. On December 4th, 2025, there was an announcement that the government is planning to sell 15% stake in Safaricom PLC, which will raise about 240.5 billion Kenya shillings, although some reports talk of 244.5 billion Kenya shillings. These proceeds are to be channeled into the NIF and a related sovereign wealth fund. Official discourse promises that the NIF will not just be not just fund infrastructure. It will take the break cycle of past privatization plan whose proceeds vanish into the current budgets with little to show in lasting infrastructure. Under the new model, privatization revenue is to be ring-fenced and reinvested into tangible public assets. What could go right? The promise of a silent revolution. If the fund works as designed, the potential uptick or upside is significant. The first one is mobilizing large-scale capital without increasing debt burden. By channeling private sector investment through PPPs and leveraging privatization proceeds, Kenya could avoid incremental sovereign borrowing at a time when debt sustainability is a serious concern. Second, faster infrastructure delivery. Long-term projects, roads, dams, energy, water, all these often store due to funding gaps. A well-capitalized fund with stable financing might accelerate delivery, reduce delay, as well as increase accountability. Third, we have attracting institutional investors. By backing infrastructure as investable, revenue-generating assets, the NIF could draw in pension funds, private equity, and development financials, creating a diversified funding base. There's also the potential for transformational impact as the other upside. If executed well, the fund could underpin major shifts, linking remote areas to market, expanding irrigation and climate resilience through dams, enabling industrial growth through reliable energy and transport networks, and unlocking long-term economic competitiveness. Indeed, the government cites experiences of other countries whose sovereign or public funds underpin sustained national development, suggesting Kenya could emulate these successes. Why experts and skeptics should raise red flags. Yet, for the ambition, a deep-level technical critic reviews serious risks. From a project management and institutional governance viewpoint, several structural challenges and contradictions stand out. One, leveraging math on stable private sector buying, which is far from guaranteed. The NIF financial model counts heavily on attracting private and institutional investors over many years. Officials have spoken of attracting the 10 shillings for every 1 shillings of privatization proceeds. But for that multiplier effect to work, the projects must be bankable. They must offer predictable returns, transparent cash flows, and legal and regulatory stability. In many emerging economies, PPPs, this is where things break down. Delays, cost overruns, governance failures, weak feasibility studies, regulatory pushback, currency risks, or even political interference undermining investor confidence. The global experience, as documented by institutions such as Public-Private Infrastructure Advisory Facility, PPIAF, shows that countries with weak institutions often struggle to convert private capital pledges into successful infrastructure delivery. Hence, the NIF is the only strong as the weakest link in the chain. Governance, transparency, proper project selection, and long-term institutional discipline. Second, this privatization proceed assumption that they are finite. Turning them into a lifelong funding source is an illusion. That's what the experts say. Selling 15% stake in Safaricom may yield a windfall today, but that is one-off event. Once privatization proceeds are consumed, the fund will need sustained recurring sources, consistent PPP inflows, returns from earlier projects, or new assets sales. If those don't materialize, the NIF risks becoming a hollow promise, or worse, just another mechanism for diverting funds without accountability. Past history in Kenya shows privatization receipts were often absorbed into general budget and never translated into lasting public assets. The NIF promise rests on a strict enforceable ring fence, but ring fences can leak if governance is weak. Third, the vision for mega projects everywhere risk overstretch the misprioritization. The aspirations attached to NIF are huge: roads, dam, energy, logistics, irrigation, smart city expansion, and even more. But mega projects are notoriously risky. Big capital commitments, long lead times, environmental and social impacts, high coordination costs, and vulnerable to scope creep. If not properly prioritized, the result could be scattered portfolio of half-finished project, cost overruns, and long-term debt obligation for associated PPPs. A disciplined project management framework requires careful selection, rigorous feasibility studies, robust cost-benefit analysis, phased rollout, risk management, and transparent procurement. Without that discipline, the build-fast drive may result in stranded assets. Fourth, political economic promises of a Singapore-style model clash with local fiscal realities. The NIF narrative frequently invokes foreign examples like Temasek Holdings, Singapore Sovereign Investment Fund, and other global funds, as these can be models to emulate. But replication is not simple. Those funds operate in mature political economies with stable institutions, transparent governance, and strong rule of law and public accountability mechanism. Kenya institutional government environment remains fragile. Public funds and budgets have often been used for political mobilization, patronage, and recurrent expenditure, raising serious questions over whether ring fence will hold. In effect, there is a contradiction. On one hand, the government insists NIF will be run commercially, insulated from political interference. On the other hand, same political system consumes the annual budget for politically expedient spending. Unless governance reforms are deep and binding, the whole structure risks being undermined from within. Fifth, there is lack of proven legal and institutional foundation. The architecture that's still fragile. Although the government says National Infrastructure Fund architecture rests on reforms under the recently passed Government-Owned Enterprise Bill, the detailed regulations, institutional governance, accountability framework, and transparency provisions are yet to be fully made public. Without such clarity, it's hard to guarantee that privatization proceeds will be managed prudently, that projects will be selected based on merit, or that mismanagement will be prevented. History offers many cautionary tales. In countries where similar funds have created or were created without strong oversight, the funds end up misallocated, compromised, and simply failing to deliver the value. What can Kenya and the citizen demand now to make National Infrastructure Fund succeed? If NIF is to live up to its promise, here are some non-negotiable prerequisites. 1. Transparency and accountability, where there is full public disclosure on NIF governance charter, project selection criteria, contracting processes, financial reporting, audit frameworks, and timelines. 2. There must be phased, prioritized project planning. Start with a small number of high-impact, low-risk projects to build credibility. Avoid the temptation to launch dozens of mega projects at once. There's also the third one, which is institutional safeguards, independent oversight body, clear separation between political decision making and project execution, and protection against graft, cost inflation, and corruption, and that it's non-negotiable. 4. Bankable project design, another non-negotiable prerequisite. Rigorous feasibility studies, realistic revenue projection for PPPs, proper risk sharing mechanism, adherence to international best practices in procurement and project management. The fifth non-negotiable prerequisite is sustainable funding beyond privatization. Long-term strategy for revenue generation, for example, tolls, user fees, dividends from completed projects, not just one-off sales. In conclusion, we can see that it is a plausible but fragile path forward. The National Infrastructure Fund is arguably the boldest imagining yet of how Kenya might finance its long-deferred development ambitions. If executed with discipline, transparency, and careful project management, it could indeed catalyze a wave of much-needed infrastructure such as roads, dams, energy, irrigation, logistics, and help unlock Kenya's economic potential. But as any project management expert will warn, big money alone does not guarantee success. Without strong institutions, rigorous oversight, and sober prioritized strategy, the NIF risks becoming another bold headline, not a legacy. The gap between the promise and delivery in Kenya has often been institutional and not financial. If the underlying political economic remains unchanged, especially the temptation to divert resources from short-term political gains, patronage, or populist spending, the NIF could end up as yet another missed opportunity. So in short, yes, the NIF is a plausible move, hopeful but fragile. It may only succeed if we as a society demand infrastructure fund that does not become a code for political slash. So thank you for reaching this far. If it's your first time here, please consider subscribing to this channel. Also, watch other videos that you have done on different videos. You can leave a comment about this yet to be launched National Infrastructure Fund and whether it will realize its objectives. Thank you.